welcome to Wealthy Money TV. My name is Vangile Makwakwa, and on today's show, I've got my financial advisor with me again. Yes, I love her company. We talk for hours. She manages my money, so I have to love her, right? So anyway, today we'll be talking about investing, and we're going to be focused mainly on risk profiles and getting started investing on the stock market. So welcome, Shanine. How are you?
Fine, and you? Thank you for having me.
Thank you for coming again to answer even more questions.
It's only a pleasure.
Okay, so Shanine, I'm just going to jump right into it. How can someone start investing in the stock market?
The stock market itself is actually quite difficult if you want to go directly. Now you can, some of the banks, what they do is they give you a program that they allow you to invest in stocks.
Yes.
But it is more expensive in terms of you need to have enough money to put in there, and they say that you actually shouldn't put in stocks because it's quite a high risk portfolios. You shouldn't do that unless this is really your extra money.
Okay.
So, but unit trust is very similar to stocks. It's only just a collection of stocks.
Yes.
So that is the easy way to get into it, and that doesn't cost a lot of money to start.
Okay. So with the banks, so I would need how much to get started in the stock market roughly?
I think it's 5,000.
Okay.
Can be corrected. I think each bank has got a different thing.
Okay.
But I think it's 5,000. They will give you the program.
Yes.
And they will open it up for you. But they won't teach you how to use it, and they won't teach you what stocks to use. That's going to be now on your own recognizance. If you make a mistake, they're not taking any responsibility. So that's why it really is for the more experienced investor. I would be very hesitant to say that just anybody should invest in the stock market. So
how would I get started investing? By choosing stocks. So let's say I've got my 5,000 Rand and I'm going to go do this and start my own stock portfolio. How do I start?
Okay, so you've got your money. It's extra money. It's not your bread and butter money, and if you lose it, you're fine with it.
I love the fact that you're getting very clear on that.
Yeah.
But okay. Yes.
So you need to understand that because it is high risk funds.
Okay.
Then you've got to decide, for example, what type of investor are you? Are you a cautious investor? Are you a conservative investor? Are you a moderate investor? Or are you a high risk investor? Now that's very important. There are tools that you can use. There's normally a little test. You can do it online. If somebody's interested and they want to test, I'll email them one. It's a simple thing that questions that they ask you to find out exactly, are you comfortable with risk? And are you comfortable with risk over the term that you want to invest? So this type of test, it's called a risk profile.
Yes.
You can Google one, I'm sure that there's many on the internet. It just tests to see how much risk you can take, over what term.
Yes.
If you are, for example, a very low risk investor.
Yes.
And you're too scared to lose money over any 1 year period. In other words, you say, look, I don't mind, but if I give you 300 Rand, don't come back to me and say, no, you only have 50 Rand left, because then I'm in a meltdown. Then you are not a high risk investor.
So what I'm hearing is that you've got to understand yourself emotionally as well, right?
Absolutely.
So high risk is if you can handle losing money.
Yes.
And losing lots of money in a short space of time. You have to be okay with that. But the beauty of high risk is that you also make high returns.
That's correct.
In a short space of time. So it's a big gamble. And
absolutely.
If you are not emotionally equipped to deal with that, don't bother.
Emotionally or financially equipped.
Emotionally or financially equipped.
Okay, yes. So it's fine to take some risks on a little bit of money.
Yes.
But you take a lot of risk on all of your money is silliness.
Yes.
So it's just not common sense.
Yeah.
So I would say to you that if you're going to try the stock market, try it. Make sure that it's your extra money. Make sure that you are happy to lose all that money. As if before you go into it, you must know that you're throwing the money away. Because people will lose their money in their first couple of, until they actually learn how to use the stock market.
Can you be a low risk investor and still invest in the stock market?
It's very difficult.
Okay.
You can,
yes.
And you can choose blue chip companies. Now blue chip companies are companies that are like Pick n Pay, like ShopRite. They are companies that have done well, they're very big, they're unlikely to be liquidated, they're unlikely to go down.
Yes.
Those are blue chip companies.
Yes.
and investing in them, you can't really go wrong.
Yes.
But you can have small, sometimes something happens. Cecil, for example, if petrol prices go in the wrong direction,
like now I think the oil price drops,
then those are going to have major implications on your things, on your investment, and you'll see it in your rands and cents, literally.
Okay. So I'm also hearing from you that as an investor, it's best for you to understand how macroeconomic indicators impact your stock portfolio.
Absolutely. So be very careful when you want to go into straight stocks.
Yes.
If you want to just put your foot in the water, then unit trust really is the best way to go.
Yes.
You have a fund manager that manages it for you. On multi-manager funds, in multi-manager unit trust funds, you're saying to the fund manager, I'm giving you a lot of gap.
Yes.
Okay, I want some equities. I don't want to lose too much money. And he doesn't choose one stock,
Yes.
like just Cecil or just Pick and Pay. He chooses a combination of 10 to 15 different types of funds,
Yes.
and that diversifies your risk, so you're not taking that much of a risk, and you're unlikely to lose all your money.
Okay, so who would be your moderate and low risk investors? Just generally speaking, there's some people that are probably watching and thinking, am I a high risk or a moderate? I'm definitely high risk people, and the reason why, when I did the test, I don't have any dependents, it's just me, so I can afford to take a little bit more risk. And obviously because of my entrepreneurial background, it means that I've kind of learned how to handle losing everything. I may regret saying that because I don't know how well I've handled it, but yeah, that's the general idea behind the high risk investor. But
okay. I'm going to try something. I hope that I'm doing it right. If you take your hand, you can say, for example, on a low risk person,
yes.
it's 2%, 4%. So as your risk goes up, 2, 4, 6, 8, 10% growth that you can expect on the inflation. But you can also, then you must prepare to lose all your money. 80%, 60%, 40%, 20% of your money, and that's basically giving you an idea of how much risk can you stomach over any 1 year period.
Yes. Yes.
So
Okay.
that should give you a good indication.
Okay, that gives you a good indication. That's awesome. I love that. So my last question is, how do people deal with the negative emotions that come up if they've invested in the stock market or invested in unit trust before and it hasn't worked out? In fact, they've lost everything. This is actually a question that a friend has asked me to ask on her behalf.
It's actually it's a very good question, and it's a general question. People lose money when they do a couple of things. For one, they start an investment,
yes.
and it doesn't really matter whether it's a savings or retirement. They put in money aside, they negotiate initially their contract,
yes.
and then they forget about it for the next 10 years. Markets go up, markets come down, the economy changes, politics change, and then sometimes they're horribly surprised, especially when it comes to offshore money. So for example, at one stage, it's normally every 5 to 7 years, investing overseas is the best thing since sliced bread.
Yes.
And then all of a sudden when they look at their things again, they haven't realized that actually offshore hasn't done well, local has been much better, and that's where they actually see. So the trick is, stay in contact with your financial advisor, look at it at least every 6 months, and you are far better off by doing that, and choose within your risk profile.
Choose within your risk profile. Okay, wow. Thank you so much, Janine. This was very insightful.
Absolute pleasure.
Anyone that wants to get in touch with Janine, her contact details are at the bottom of the screen, so you can call her or email her. And if you absolutely love what we do, please sign up for the Wealthy Money newsletter on our website. That is also on the screen. The address to that is also on the screen. Or subscribe to our YouTube videos. So just click on the subscribe button and you will get these videos every week. Thank you very much and have a phenomenal day. Bye.